Time for Hot Picks. We're focused today on the restaurant sector. Our guest's first idea is Dutch Brothers, a drive-through coffee chain. We are joined by Andrew Charles, Managing Director and Restaurant Analyst at TD Cowen. Andrew, great to see you. What's the attraction with Dutch Brothers? And thanks very much for joining us.
Oh, thank you, Andrew, for having me. So Dutch Bros is about a 1,000-store coffee concept in the United States, the third largest. We're bullish on the coffee category, but specifically for Dutch Bros, they did some great self-help in 2024, focused on advertising and a great beverage innovation platform. And we really like the catalyst path from here as they just added mobile order in 3Q24. It's about 11% of their sales today. You compare that to Starbucks at about a third of their sales. So safe to say they're in the third inning within the mobile order journey, which is proving to be incremental. And then combine that as well, they'll be adding food most likely in 2026. And so we really like the ability here for this to be a mid-single-digit same-store sales story for 2024 through 2026 to really help drive multiple expansion for the stock.
And what's different about them? Is their coffee distinctive?
Yeah, so what's different is that their portfolio, about 23% of their sales, so almost a quarter of their sales, are from energy drinks. This is a category that skews younger. The concept is, well, drive-through only, no lobby. So a little bit different from what you would see in the United States relative to a Starbucks and Dunkin'.
Your next idea is in chicken wings. Tell us, obviously fascinating. Chicken wings, they used to be just given away, didn't they? But they've become a major part of some people's diet in recent years.
I include myself in that, by the way. So yes, it's used to be, they've now become a center of the plate offering, Wingstop, which is the largest, chicken wing seller in the United States. What's important about this one is that, not only is the category great, the box economics, it's the strongest cash-on-cash returns within publicly traded restaurants. What's really important here, though, is that they've got a new initiative they're rolling out called Smart Kitchens. And what Smart Kitchens are able to do is to really be more predictive on when to prepare their food. I think what's important about Wingstop, Andrew, is that you've got the fact that it's the simplest operations within our coverage universe. And so with cook times of about 13 minutes and pretty strong demand forecasting, helped by AI, they know when to expect orders to be coming through. And so they can prepare orders largely on a predictive basis. And what's important about this, they still uphold, the 10-minute hold times, for the product as well. So they're not seeing much waste, but we're hearing thus far that it's been about a 5% plus lift to their same-store sales. We think there'll be a long tail to this as they roll this out over the balance of this year. Combined as well that over time, the third-party delivery aggregators like DoorDash and like Uber will start to notice this a bit more and include Wingstop more often in the sub 30-minute delivery times, really leading to a long tail to the sales lift in our view.
And so you said they basically have a simple menu, and obviously that's more efficient because that's the thing. Some restaurants just have too long a menu.
Very much so. I mean, they sell boneless, bone-in chicken and French fries, and that's about it in terms of food.
The minimalism, of course, that's how McDonald's started, didn't it, decades ago? And finally, Chipotle, you see upside there.
Yeah, so Chipotle, in our view, is implementing the right playbook to help accelerate sales after facing some tough comparisons earlier this year. They just launched an adobo ranch dressing about a week ago. They're increasing the marketing spend, which is pretty powerful when they've got a top line growing north of 10% longer term. Combined as well with the fact they're really trying to do more loyalty engagement. And it's pretty interesting that they've got 45 million people in their loyalty program. So over about 15% of the US population's in the loyalty program for them. 20 million, though, are active. And so keeping these folks engaged is going to have big benefits for both traffic and for ticket. And so we like what they're doing there on top of what's a great long-term operations plan led by their CEO who comes from an operations mindset. So really like the drivers they have in place here to really help accelerate traffic growth.
So they're in Canada, they're in Britain, France, Germany, and the Middle East, and they plan to open locations in Mexico. It's going to be interesting to see how they do. But do you think this is a franchise that could be taken globally?
I think so. I mean, Canada, we spent time with management up in Canada last week. It's a great story in terms of how they've been able to improve margins and the reception they're seeing as they grow across Canada. They're trying to implement the same playbook they have in Canada in Europe. They're seeing success in central London as well as in Frankfurt, Germany. And the idea here is that they want to continue to expand globally, preferably own the stores. There'll be equity stores as they grow, but they found great partners in the Middle East and Latin America where they're still in early days and just starting to open stores there. But big, they have big aspirations for global development. But the important part here is that even if we just put that aside for 1 second, they have the opportunity here to double their unit count in the United States for what's been very strong new store economics, showing great portability of the brand in the United States. So great long-term growth story in the United States, virtually untapped internationally.